mean, I guess I'll start with an overview and kind of a segue from, I heard the tail end of your prior speaker. I mean, it is one where fixed income markets right now, and it is across the board. It is not just high yield. Liquidity is quite poor, and I'd probably more simplify it as more just there's just a lot more sellers than there are buyers right now. I mean, you're getting, whether it be open-ended complexes, ETFs, and the like are kind of redeeming all at the same time, and there's really no buyers at the other end. I mean, you are starting to see a little bit more nibbling around the edges. In certain instances, in some of our institutional money, we're getting a little bit of money, but it's not enough to offset from a market perspective outflows you're seeing. And again, that's not a high yield credit thing. It is a all fixed income thing. I mean, when I talk to our treasury traders, and we're kind of having daily all hands on deck calls at Neuberger, liquidity in the U.S. Treasury market is quite poor. And even last week, before the Fed came in, it was very hard to sell off-the-run treasuries. So that kind of gives the extent of what's going on. I'll kind of flick through a couple of these slides real quickly if you have any questions. First on page 2, not goes without saying, obviously there's some industries that are more impacted than others. Up until probably, called Friday, you definitely saw a bigger separation in price between, the stuff that's higher impacted and lower impacted. And just in the last couple of days, you've seen kind of that lower impact stuff move down actually quite a bit. And what's happening in fixed income, and I've seen it before, is kind of people play the high dollar, low dollar trade. I mean, the higher dollar price bonds you want to sell and buy the lower price bonds because, in a recovery scenario, obviously your upside is much greater on those lower priced names. Obviously the biggest single risk, and I guess I would disagree with the prior speaker. The number of the dollar price of the amount of credit assets out there, it's somewhat irrelevant. It's only if they start defaulting does that become a problem. And when we kind of look across our universe, we've kind of stressed names. We're just assuming you have 2 quarters of zero revenue, and so that's not zero profits. That's literally like zero. And by and large, that really doesn't change the default rate. Energy is a different story because oil prices collapsed for another reason. But by and large, a lot of these companies still survive. It's really if it kind of occurs for several years. If you flick to page 4, one of the things that matters the most is if you have maturities, that's kind of what trips companies up. I mean, what we tried separating out is companies that are more coronavirus exposed, and there's not much debt coming due, and a lot of them have access to capital to try getting them through. I guess one of the questions, is okay, kind of what's going on in the world. Well, what do you do? Do you sell? Do you buy? The thing with credit, and we've always said, is like, look, as long as the companies that we own are continuing to pay their interest and make their maturities, the companies don't default, and the bonds eventually go back to par. And usually that snapback's pretty quick. So what we have here is a J.P. Morgan study, is when spreads exceed 800 basis points, what's been the prospective returns over the next 12, 24, and 36 months. And today, spreads got to like 850 off, or closing like 850 off, so we're there. You see the median annualized return, but I think more interestingly is you look below. So it's happened 44 times in the last 30 years. 42 of them you were positive in the next 12 months, negative twice, and then 24 months, 36 months, you're never been negative. I'll use March '08 as an example because that was one of those negative periods. So from March '08, spreads hit these levels. March '09, so over those 12 months, you were still negative. You were negative, I think, maybe 10%. But by June, you were positive. So instead of taking 12 months to recover, it took you 15 months. And, the thing with equities, it took 5 years for equities to recover from that point. So, it is one where the snapback in credit generally happens quicker than equities. I mean, obviously then after that, equities started really rallying as they should, but it just doesn't mean your return outlook's the same. I mean, I will kind of lastly just talk about, look, our NTA has gone down. It's been kind of mark to market on names. I mean, you look at names like first, probably I'd call it the least coronavirus exposed name out there, which is Netflix. And I'll tell you, starting the first day of working from home for probably a month, and the first day of my children being at home for a month, we will definitely not be getting rid of Netflix in the house. Those bonds, from the time we had this are down. On here it says 10 points, but even after today, they're down another 6 points. So you have a company there, almost down from their highs, almost down 20 points. And then you have a company, Merlin, which, high quality asset. They own London Eye, Madame Tussauds, Legoland, a few other high quality properties. 0809 grew revenue and grew earnings. 15-16 grew revenue, grew earnings. We're just assuming they're going to be shut down for 2 quarters, which, it's kind of embedded in the bond price. So it is here down 30% after today. It's actually more down like 30%, down like 40%. That company burned like $75 million of cash. It has $500 million of liquidity, and the first maturity is 2026. This company, it will take a while for it to go bankrupt. I mean, and so we're not selling here, but you can kind of see the impact you've seen. And I will say this, I mean, with that steep decline, this is a bond I'm fully anticipating will recover to par fairly quickly. So, that kind of leads into the, where we are, and we still think, there's good opportunities out there. Lastly, kind of on page 8, and this is as of the end of February. I mean, you see a pretty diversified portfolio, top 4 sectors: services, media, telecom, and healthcare, make up over a third of the portfolio. So we still feel pretty good on what we own. And with that, I kind of leave it there. I mean, we open it up for questions or any thoughts or anything I can answer.
Vivek, just one. I mean, one area that people have questioned is like energy exposure. Maybe you could just touch on the energy exposure in the portfolio.
Yeah. So 3.9% of the portfolio. A chunk of that is companies where they're quasi-national owned companies, and companies that are natural gas related. So the actual of that energy and exploration that's more oil related is called 70 basis points spread across 7 names. So it's fairly low per name. Those are a little bit more impacted. So we're assessing, kind of between where they're trading, we think kind of recovery values are, and the runway that some of these may have. So, but the actual impact of the oil drillers who are most affected is fairly low in the portfolio.